So you have a UK limited company and you want to pay yourself. What on earth would you want to do that for? You work hard in your limited company, now you want to take money out? Are you crazy? You nuts? Well, okay. You want to pay yourself money, huh? Well, let's find out how you can do that in the most tax efficient way. So the problem is with taking money out of your limited company is complexities. You have income tax considerations, you have corporation tax considerations as well, and that is not easy to understand. So we really want to help you understand the best way to take money out of a limited company, and for you to understand, does that help you save corporation tax as well? So my name is Simon Mishevich from Optimise Accountants. I help landlords and UK property investors save tax whilst building their wealth. And there is our website, so feel free to go and see that. Now, there are a couple of free products that I would like you to download for free. There's the ebook, which I've just updated recently for the new tax year. So use that QR code. The link will also be in the video description. There is also a property tax course that you can watch right now on YouTube, looking at that QR code, or again, the link will be in the description box. We've recently developed a new map on our website, so you can use that QR code to go to a website and see this. This is going to be a map to help you understand who can help you grow your property business. And it's going to have on there property sources, it's going to have joint venture specialists, it's going to have mortgage brokers, all that kind of information will be on this map. It is new, so there's only a few people on there currently, but it will expand over time. So I want to share with you the income tax rates that you typically pay. This is you personally. Now, I'm going to look at it from the aspect of you taking a wage from the company, income tax, but you also have a different rate of income tax for dividends that you take out, which I'm going to put in brackets. Now, the personal allowance of £12,570 means you can take that money and it will be tax-free. So if you pay yourself, you're from a limited company, a wage of £12,570, you personally will not pay any other form of tax on that. However, if you've already got other forms of income, in which it can lead to complexities, you should make sure you work with your accountant to see if this taking a wage out of your company makes sense. I've seen before that we have a client that says to their accountant, oh, I'd like to take some money out of a limited company. Yes, of course, you can take wages, or let's say £5,000, £10,000, and they didn't tell them that they're employed. Big gaff right away, because really that person should pay emergency tax on that money taken out of the limited company. RTI filing errors all over the place and penalties galore. So please be careful before you do anything like this yourself. That said, the £12,570, assuming you have no other form of income, you take that out of the limited company as wages, that would be tax-free. What's in brackets of £500, you dare ask? Well, I can tell you. You can take £500 worth of dividends out of your limited company and that will be tax-free. Hence the reason why there's a 0% tax rate on the right and a 0% tax rate in brackets. So I will put in brackets anything to do with dividends going forwards. As a basic rate taxpayer earning up to £50,000, 270, you will have a 20% tax charge on any wages out of your limited company. Now, the problem is with this is that you've got employer's national insurance, so employee, you as an individual, and employer, as in your limited company, both will have national insurance charges on wages, typically above 12,570. And that's really a downside to this. So I would say that 12,570 is a cap, an upper level of the amount of wages you should take out to your limited company. Oh my gosh, spoiler alert. Okay, so there you are, right said. Now, when it comes to dividends, if you take out dividends up to a basic rate tax band, you will pay 8.75%. Now, don't be fooled. That 8.75 is not there to be celebrated. And the reason for that is because you would have already paid corporation tax on your limited company. So if your limited company is paid 19%, you've got this extra 8.75% of income tax on the money you take out. Please note as well, when you're taking out dividends, that you have to have profits in the company in order for you to extract dividends. High rate taxpayers, so someone earning between £50,271 and £125,140, they would have to pay an income tax charge of 40% plus that national insurance I talked about earlier. So again, not worth it. If you're paying yourself dividends, then the income tax rates on dividends as a high rate taxpayer is 33.75%, which is quite phenomenal, actually, especially when you pay 19% corporation tax. That's quite stealthy. And then additional rate taxpayers, let's not go into this. So it's clear if you're a high rate taxpayer, taking wages, taking dividends out doesn't really make much sense because you'd be paying far too much tax. Additional rate taxpayers, £125,141. You face an income tax liability of 45%. Again, on top of that, you've got national insurance for both the employee and employer. If you take out dividends as an additional rate taxpayer, you'll be paying 39.35%. Wow. Okay, so let's have a look at some of the ways that you can take money out of your limited company. And again, I'm going to stress, this assumes you have no other form of income. So if you're employed from an employer, you've got PAYE income, then this may not all apply to you. So you do need to get some advice from your accountant or us. And you can do that by using that property tax advice QR code that's showing on your screen, by the way. So I've already said the spoiler alert is pay yourself £12,570. Why not lower? Is there not a national insurance charge? Yes, for the employer above £5,000 with the new rate, which is really kind of strong from HMRC, where they charge you 15% national insurance. But that 15% national insurance does get tax relief. The company also gets a tax relief from anything above £5,000 to 12,570 in this example, where you are charged as national insurance. So overall tax impact, you are still better off taking the full amount out of your limited company because it's your money then to do whatever you want to do with it. So from a tax perspective, it does make sense to pay yourself that wage. And if you've got other employees as well, then there are other things you could do in terms of getting national insurance credits, but I'm not going to go into that right now. £500 worth of tax-free dividends. So I've already said that. So now there's now £13,000 worth of money you've taken out from your company, tax-free. The £12,570 would be a tax deduction for the company, so it gets a tax relief. But the £500 is paid post-profits, post-tax profits. So there won't be any tax deductions for the company on those dividends. Now, let's imagine that you have started your business and you've put money into the company as a loan. The company owes you money because you've put that loan into it. You could actually charge interest. So let's imagine that you've got £10,000 as a loan from you to the company and you charge it a sensible rate of 10%. Now, what's a sensible rate? Well, HMRC always say that a commercial rate is sensible. And that's what they will allow you to charge your company. Now, commercial rates, you could all argue, well, what's on there now? If you go to the big banks, what interest will they charge you on personal loans? And I'm sure it goes from 4 to 12%, depending on your credit rating. Charging your company 10% may be a bit high, but I think you could easily justify that, given that you're in property and property is high risk. So I think that 10% is pretty safe. Now, that £10,000 loan that you're giving to the company, if you charged it 10%, that's £1,000 that you could charge the limited company. The interesting thing for basic rate taxpayers is that £1,000 is tax-free in your own pocket, and it will be a tax deduction to the company. Now, what if you're a high rate taxpayer? Can you still charge interest? Well, yes, you can. Up to £500 would be tax-free. If you're charging the company £1,000, then the £500 of that would be tax-free. The other £500 would then be a taxable event at 40%. So you would really want to be careful about how much money you're going to charge your company for interest. Point 4 here, a really interesting one, is if your company has a lot of cash, lots of profits, then one of the things you might want to do is make a contribution towards your pension pot. Many people that we work with set up a SaaS pension. Why is that useful? Two reasons. First, the £60,000 goes into the company. The company gets tax relief on that pension contribution. The money then going into the SaaS could be loaned back to the company to a certain degree. I'm not going to go into the details here, but certain amount of money can be loaned back to the company. Over a period of 5 years, the company could use that money and pay an interest to your SaaS, which then in the SaaS is tax-free, build-up of interest, growth, etc. But for the company, it gets tax relief on the pension contributions and tax relief on the interest that the SaaS pension has provided as well. So really a double whammy in terms of building wealth and taking it out of the company to pay less tax. Medical expenses. If you are of a certain age like me, an old person, you might want to have doctor's appointments, medical checks. So as a company, it's responsible for its directors and wants to make sure that they're healthy. So sends them to a private medical center to get a well person check. That well person check can be a tax deduction for the company, not me expensing it personally. Equally, if I'm working on my computer, which I do, and I need glasses, which I do, the company could pay for my optician's appointments and my VDU glasses as well. None of that money is coming out of my pocket. It's coming out of the bank account of the limited company, which means it gets full tax relief on those payments. Point 6 is vouchers. You could, from the limited company, pay yourself vouchers, non-cashable vouchers. So I'm talking about an Amazon voucher or All for One store card where you can go into a shop and purchase items for yourself. Now, as long as you don't pay yourself any more than £50 worth of vouchers in a given time frame, which is typically a month activity, then that will accumulate to £300 for the 12-month period, which means none of that is going to be a taxable event. And guess what? Yes, it will be a tax deduction for the company. So no tax for you, but a tax deduction for that limited company. So there are 6 ways in which you can legitimately take money out of your limited company and pay no tax yourself. There we are. So my name is Simon Mishevich, and I'm here to help you as a landlord, property investor, build your wealth. If you want to know how we can help you, feel free to use that QR code to book 10 minutes with me, and let's see how we can build your wealth, but keep away the tax man.